Low-income housing tax credits, or LIHTC, is a tool that was established in the mid-1980s by the federal government as a tool and incentive to preserve and develop affordable housing throughout the country. We are not a tax credit investor or syndicator or consultant, but we do get a lot of inquiries about the program, how it works, how to get started. If you are new to tax credits, have no idea where to get started, I can't emphasize enough, Google your state name and the letters QAP, that stands for Qualified Allocation Plan. The QAP and your state name will bring you to a website where you can see a guidebook on deadlines that would be involved as part of the process, requirements, developer fee limitations, everything that you might need to know from beginning to end is generally going to be available on the website that you can find by searching your state name with the letters QAP. The LIHTC program does not operate with rental subsidies, so there is no Section 8 HAP contract required. Tenants that live in a LIHTC building are not getting any sort of monies from the government if they cannot afford to pay their full rent. Instead, the way the program works is that you as a property developer or owner are agreeing to rent limitations for 30 years. So the rents that you have to abide by vary depending upon project area and depending upon the median income in that area. If you're not sure what the rents are, there are some great calculators and tools online. In particular, Novogradac has one, so Novogradac, Novogradac LIHTC rent income calculator. You can Google that and see what rents would be on a studio, 1-bedroom, 2-bedroom, 3-bedroom basis in your area. That's important because generally if you're looking to do affordable housing under this program or preserve affordable housing, like rehabilitate a building, the construction costs that would be involved are no different than if you had a market rate or luxury type of development, but the income that you receive from tenants is lower. It is a affordable housing. So getting an idea of what those rents would be, what type of total income would be available, is very critical to determining the overall feasibility of whatever project you're looking to do. There are two core types of tax credits that are available, 4 and 9%. For the purposes of brevity, think of 9% as equaling 90% of the development cost of a transaction and 4% equaling 40% of the development costs. So in this instance, this is a 4% scenario in this graphic. You have a project with a $10 million cost times 4%. You get the $4 million, 40% times a purchase price. The investor that would be your partner that's providing that money is going to be buying these tax credits at a discount. And then that is the actual money that would be contributed to you that would cover developer's fee. You may be wondering if the 9% is worth more or provides more capital than the 4%. Why doesn't everybody do 9%? Well, the 9% is very competitive and it's limited on an annual basis. So if you can get the 9% credits, most of the time you do not need to take on HUD debt that we offer or bank debt. That can be all the capital needed to fund the loan and do whatever it is that you're looking to do. But because it's so competitive, a lot of individuals and developers opt for the 4% credits that you can still get the developer's fee, still get all the benefits of the program. You combine it with debt options like HUD or bank financing, and that provides a complete package and allows a project to be feasible. The structure of a tax credit transaction is a literal partnership. So the investor from that previous slide that's providing that tax credit money, that's purchasing those tax credits, they will be a literal partner with you. There will be a partnership agreement that is formed, and they generally take a more hands-off approach. So if you are the general partner, you are the person that's going to be sort of in charge of construction, putting the pieces together. You can retain the majority of the cash flow typically. You typically take control or retain the majority of the management or operational procedures that would be involved with a multifamily asset. The limited partner is more of a passive investor. However, they're not necessarily benevolent. There are a lot of strong controls and different items that you have to abide by as part of that partnership agreement. So it's important to make sure that even early on when you're forming that agreement, you're thinking not just of the initial stages or 5 years from now, 10 years from now, but what happens when that partner is potentially going to leave. Generally, as it says in the slide, the limited partner, the investor partner, is leaving after year 15. And you can Google year 15 LIHTC and see some stories of some challenging situations where the investor partner wants a large amount of money to leave or has these various stipulations involved. So making sure that when you're structuring the deal, you have to look at it not just from a dollars and cents and construction cost perspective, but from a partnership perspective, and making sure that whoever you're partnering with, it's going to be an equitable relationship and a fair relationship for you. And the tax credit program is very powerful, and it's really a win-win-win for all parties. Although there are some things to be aware of and consider, you have a massive amount of affordable housing that has been developed and continues to be developed with the program, which provides lower income residents with safe, quality, affordable housing. You, as the developer or the partner, the general partner, can secure large developer fees, many times in the 7-figure range, and you can limit your out-of-pocket capital that would be needed. The tax credit money can essentially be your capital to get deals done. And for the investor partner, the people that are providing the tax credit monies, they receive real estate losses or a variety of ways that they recoup their investment that can be very powerful and provide a very strong yield from their end. So this is one of those rare scenarios where when it's done right, it truly is a win-win-win for all parties. Of all these slides in this video, this is probably the most important. I have a lot of individuals that reach out to me and ask about, I have no development experience, I have limited capital, limited balance sheet. Can I be a developer in a tax credit deal? Can I do one of these deals? And the answer really is no, you can't. I'm not aware of any tax credit investor partner that would partner with a group or an individual that has limited development experience and limited capital. You need to show a very strong track record for these groups to get involved, because again, this is a long-term relationship and they're not receiving their return on investment for a long time. So if you think that this is like money that's coming from the government or easy money, free money, it is really not the case. It's a sophisticated financial transaction and is going to require a lot of experience on all parties in order to make these projects feasible. So I hope this video was helpful. Just wanted to provide a brief synopsis. That calculation of 4 and 9% that I mentioned earlier is really a gross oversimplification of how this works. But I have a calculator that I can send to you if you're interested about what type of tax credit monies could be available based upon your project scope and budget. I have various handouts that explain this in more detail. So please leave a comment, send me an email, call me, and I'm happy to provide more information. Thank you.